And now, this world shall know pain. Almighty push!
Welcome back to the channel, guys. We're going to go and look at different indexes, components of the index, news, stuff to be wary of in the coming week, and just a whole bunch of different type of stuff, man. So let's go ahead and cut the bullshit and get straight to technical analysis, man. First, we're going to be looking at the SPY. It's been in a falling wedge or this downward sloping channel, whatever you want to call it. We basically broke out of that with lackluster volume. So that's definitely something to take note of and to be wary of whenever you are trading. I mean, even on the smaller time frames, we were oversold. There was the possibility of having a divergence, but we ended up keep rallying to the upside. You know, we kept riding this 9 EMA and the 20 EMA on the shorter time frames and just kept making up new highs. What would be healthy for the markets to get a pullback, possibly fill these gaps, maybe even test some of these levels, these key levels, and basically ultimate shoot for higher highs. Same thing for the QQ as well. We had the breakout, created a gap as well from the Thursday to Friday trading session, lackluster volume once again, but ultimately we have some possible gaps to fill the upside, but there might be some reasons why we ultimately will sell off to the downside. Something to take note of is basically we broke the streak of red candles in a row on the SPX, the SPY, the QQ, whatever you're looking at, basically. And there's been 7 downward weeks, but there hasn't been 7 red weeks in a row, basically ever in history. So this was definitely a historical mark, historical time. The past times we had anything close or more than that was 8 red weeks in a row, 2 different occasions, once in 2001, once in 1970. We had 2, 3, 4, 5, 6, 7, 8 red weeks in a row. Ultimately, there was some good upside, and from the high to about basically the high of the next week was basically 9%, but ultimately the highest point it reached was 21, 22-ish%. And that was over the course of what, 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks. And if we look back at 1970, and also take account what type of period this was. So this was ultimately a recessionary period. And we didn't know that at the time. Nobody knew that at the time. There's people that might have anticipated it, but there was no confirmation by I forgot what the bureau is called, but basically the one who defines recessionary periods. We didn't have that yet. This ultimately was a recession, and this actually marked the bottom. I take that back. I don't remember if this was a recession or not. I believe it is. Yeah, that or this period right here was a recession. I forgot which one it was. But anyways, it marked the bottom. And basically that kind of ties into what you want to count this data as, you know. Do you believe this was the bottom or not? And if you do, you know, this kind of shows you what type of percent gain we can see in the short term. You know, we see a 16% gain over the course of, 2-3 weeks, you know, 27% over the course of maybe possibly 10 weeks. But ultimately, we made new all-time highs from this point in 1970. So again, it just depends on what your market outlook is, what your economic outlook is, everything, man. So take that into account, trade lightly if you're still unsure. We'll look at some indicators. Standard deviation channel, basically the same thing as a SPY. We took the highest point, and from there just measured what type of moves do we get. You know, we had this bounce around in the channel the whole time. We ultimately hit the bottom, and now we're in the middle of the range, so we're basically neutral. If we look at the anchor VWAP, same thing. We were bouncing around, not the same thing, but we were bouncing around between the second and the third deviation for the past 2 weeks, basically. We ultimately broke out of that, and we're ultimately heading to the upside. And actually on the SPY, we're actually currently sitting at the first deviation, possibly as resistance, as it confluences with this 415 level. So that's definitely something we could get a pullback on, you know, whether it be the 410 or possibly to fill the gap. And yeah, and ultimately push higher. Hopefully, because I got some long positions. We also got some Bollinger Bands. They're currently expanding. They were contracting, but they're expanding now on this upward move, confirming it. And we're ultimately in the overbought region now. So it's not going to say scary, but it's kind of scary because, you know, it's like how much longer can this move to the upside? I like to play whenever we're negative and play to the upside, or upside statistically out of bounds. And when we fall back in bounce is what I like to play. Currently, we're neutral. I'm in positions, I have stop losses, and I've taken some profits already. Looking to take more profits, hopefully in the coming week if the opportunity presents itself. But look at the value line index, geometric index that is. We looked at this last week. We talked about how there was a divergence. Ultimately, the divergence played out, which is awesome. We're basically saying that the general market, because the value line geometric index is equally weighted, S&P 500 is not, it was performing better than the SPY, meaning that the heavier cap, the heavier hitters were performing worse. So let's look at the heavier hitters. What did they do this week? Like we talked about last week, it was basically the trend reversal type candle on higher than average volume. Area of support, major area of support, as it was resistance 5 times in a row, ultimately breaking out on the 6th time, tested as support there. Not exactly completely, this kind of a line ranges from 137 to like 138 something, but there was a gap as well that was filled. But anyways, ultimately what I said is that it's possible we could get a bounce, ultimately test the trend line and sell off, or hit the 150 level and sell off. We haven't had the next move. Will we break to the upside, or will we ultimately continue to sell down? Who knows? Amazon, again, I said there was a type of trend reversal pattern in the middle of no man's land. I would like to see a break to the 230 through the 230-20 level in order to get some bullish momentum, fill this gap up here. However, if we were to break down the 20 through the 2047 level, I'd ultimately be bearish. But ultimately, this was pre-COVID resistance. At the time, so now it's support. So it's definitely something to look forward to in the future of what could possibly happen, especially going into the stock split that's going to be happening on June 6th. So it's something else to watch out for. I was going to talk about that later, but I already talked about it now. Google, Tesla are also two different names in order to watch for a possible stock split as well. So something else we might look at is the volatility index. Usually it's like an inverse of the SPY or the markets in general. When there's uphill battle on the VIX, there's a downhill movement on the SPY. Uphill movement on the SPY, downhill movement on the VIX, and it's usually opposite. However, recently we had this convergence. Basically, the SPY was moving down while the VIX was moving down these past 3 weeks, which normally doesn't happen. So again, that was an indicator that there possibly could be a bounce. Another thing we looked at was the NDTH, or the breadth of the market, basically how many stocks are below their 200-day moving average, and the NASDAQ, what percentage of it was when we have hit these low of levels within this range. It usually marked bottoms. So that was another thing I was betting on. Currently, it did mark a bottom, not the bottom. Well, we don't know that yet, but as you can see, it has marked bottoms in the past. One time it did fail in 2008. Unfortunately, we don't have previous data to that, as the NDX has not been that long around. In order to have a 200-day moving average of weekly time frames of the NDX, it doesn't go back far enough, basically. So basically, it failed at that point in time, and ultimately had lower lows. But it did mark a local bottom, which is, again, in the video is what I said. I might even put a clip in here. Ultimately, it did provide a short-term bounce, which is what I'm trying to argue at the moment. I'm not trying to argue about a whole trend shift. I'm just saying that that's a possible thing. And the DXY, basically we had a pullback in the markets at that time period from basically mid-May up until now, which is nice because it gives commodities, it gives equities, it gives a lot of things a little bit of a boost. Same thing with the pullback in the yields, which ultimately hit resistance in the 10-year as well as in the 2-year. And the put-to-call ratio hit I'm going to call it overbought region, but it just means there's more puts in the market than normal. Ultimately pulled back kind of in a neutral territory as it is in between the range, but it could hit the trend line during the week and basically send us to higher highs, hopefully again, but not at the moment because I kind of want to keep squeezing as much as I can out of these long positions. HGX, this is just one thing I wanted to point out on this, I guess you call it indicator, is the housing index. And basically whenever it peaks out before the market does, it has led to a recession. Once again, unfortunately there's not that big of a data set as it only goes back to 2003. But basically the only major time that's happened was that time. I'm not going to say ever, but ever. It usually, not usually, but it has marked bottoms. But anyways, that's something to look out for. Another thing to watch out for is sector rotation theory. Basically, the market precedes the economy. The economy is what drives the markets. And if you look at what sectors of the S&P 500 perform best during the market top, following into the market bottom, it'd be materials, energy, consumer staples, healthcare, utilities, and possibly financials as you get further into the downward movement. And if we look at the sectors and how they performed on the monthly basis, 3-month, half-year, or even the yearly basis, energy at the top. Utilities is next. Consumer defensive, which is consumer staples. Basic materials, which is materials. And healthcare. And financials. Basically, they're all 5 of those, or 6 of those, have been performing the best. The shorter time frame and the longer time frame. So it's definitely something to watch because that's basically hinting at there's a possibility that we could either still be in it or be heading into the bottom. We're not far off. And if we want to look individually at these sectors, I mean, you see XLE has been performing great. Would have been a good rate buying opportunity in January time. Even better whenever the whole Ukraine Russia situation happened. I mean, it's kind of unethical, but we're spitting facts. We're spitting facts. You know what I'm saying? And then basically we kept putting in higher highs and higher lows on the XLP for a while until ultimately Walmart and Target had shitty ass earnings, bro. Fuck them, as they drove the market down. But, ultimately we're back in the range. We're heading up to higher highs, had a nice move, which normally doesn't happen that big of a percentage in XLP. Once again, XLU also putting in higher highs as well as higher lows, and ultimately possibly heading for higher highs. Healthcare, a little bit lackluster, as you can see with the chart that we posted. Healthcare has been not as great, but if we get above a 134, definitely be bullish in the markets. Something else to look at is the PE ratio, price to earnings ratio, and basically the average or the mean or whatever is normal is around 15. We're currently at 21, which is a little overvalued, but it's definitely a lot better than the high 30s that we once were at all-time highs. Also looking at forward PE ratio, we're currently sitting about 17. Average is about 14, 13, That's not exact, but it's just something to look at. And if you want to look at where I got this from, this is basically it. A PDF they put out. Again, we talked about stock splits. Something to watch out for is Tesla and Google. They also plan on having stock splits, so there's someone else to watch out for whenever the shareholders do vote on it. That is, if they do go through with what they said in their earnings reports or hinted at. I believe Elon hinted at it as well. 3 takeaways basically on the Dollar General, Dollar Tree earnings. They had good outlook. They beat earnings. I'm gonna say earnings. I didn't exactly look at the numbers. I just read the articles and basically watched a video on it. But basically, as you can see from this article, even you can read for yourself. But them, as well as Costco and Nvidia, had beat earnings. Costco and Nvidia had a little bit of mid outlook. It wasn't that great, but overall, with the good numbers and Dollar General and Dollar Tree doing well is enough to keep the markets going. As well as the Fed minutes. The Fed minutes gave us what we expected. We expected a 50 basis point rate hike. That's what they said they were going to go through with, as well as following meetings. There's mixed emotions, mixed thoughts, mixed theories on what the Fed was actually saying in their meeting. As you can see, CNBC is actually pretty bearish. They expect there's more than anticipated rate hikes and more to come. However, some people are arguing that basically from what they understood from the meeting is that there possibly could be a stop of rate hikes around September-ish or towards the end of the year. So that way the Fed could analyze and see how the Fed rate hikes had affected the market so far, so that whether they could go through with more or they could just stop at the moment and let the markets kind of settle in. Because at the end of the day, they're trying to avoid pushing the economy into a recession. Things to watch out for during the week. Actually, before I go into that, Snap, earlier in the week, they revised their outlook for the market. Oh my gosh, that fucked up the markets bad. A lot of technology names were horribly down. Consumer discretionary was down. It just put us into a fear frenzy, ultimately leading us into the fear and greed index. It was 11 at the last weekend. In the last video we published, this is currently at 21, which is still bad, but it leaves potential room for the upside. So something else to take in consideration. Things to watch out for the following week. We only have 4 trading weeks, as Monday is Memorial Day. FOMC member speaks on Monday, 11 Eastern Standard Time. That is. What else? The Consumer Confidence Index for the USD for the US is coming out. What else? Job openings as well as PMIs coming out. Bullard also speaks, and if I'm not mistaken, he's the most hawkish out of all the FOMC members. So that's definitely something to be wary of. ADP employment change. That's also going to be important numbers because they're going to discuss and release basically has inflation affected how employers run their business. Employers such as Netflix have actually started layoffs. Facebook has actually stopped hiring. Will this continue, or is there more evidence of that rather than them just coming out? Are people basically hiding that? When I say people, I mean companies. FOMC member Meister, whatever their name is, at 1 p.m. on Thursday as well. Again, Eastern Standard Time. And also we have important data coming out, employment rates, as other things as well. So guys, again, I'm kind of like in a neutral territory. If you have long positions, great. Just make sure you have stop losses if you're in the green. And if you're not, then trade lightly. I'm not going to say expect a pullback, but if we do get a pullback, that would provide a good opportunity in order to get in for some longs, as we are kind of like in the middle of the range, currently heading up on some momentum. We need volume. We really, really do, because this is lackluster and this is pretty shitty volume, if we're being honest. So, guys, trade lightly. Good luck. Best of luck. Enjoy the rest of your 4-day weekend. And best of luck to you in trading the markets. Peace.